This past year has been a big one for IPOs, and I'm willing to bet that somewhere in the midst of all of these companies going public, you probably caught wind of the odd SPAC or two. But what the heck is a SPAC? And why should you care? Hi, I'm Shannon Terrell, Senior Writer for Finer's Share Trading and Investing channel. And today we're going to talk about SPACs, what they are, how they work, major risk factors, and how you can invest. Let's get started. A SPAC is a special purpose acquisition company. And the name says it all, really. These companies exist to acquire other companies. They're also called shell companies or blank check companies. But unlike traditional mergers, SPACs have no interest in taking over the company's day-to-day operations and management. SPACs acquire companies for the sole purpose of taking them public. Prior to picking up a privately held company, SPACs are publicly traded. They get their own ticker symbol, and they typically go for about $10 per share. This means that you can actually invest in a SPAC before it's acquired its target company. Now, why would someone do that? Well, I'll get into that shortly. But first, let me break down exactly how SPACs work so that you know what you're investing in. SPAC timelines are actually pretty interesting. So why don't we break this down step by step? And let's use a hypothetical SPAC as an example. Let's call this SPAC the blank check company, or blank check for short. First things first. Investors need to come together to form blank check. These investors are the company's sponsors, and they're the ones responsible for taking this SPAC public. SPACs are usually formed by investment teams with management experience, but pretty much anyone can form one. That said, the process of launching a SPAC is complicated and shouldn't really be undertaken by someone who doesn't know what they're doing. Now, before blank check can merge with a target company, it has to go public. In fact, SPACs undergo the same IPO process as any other company preparing to list on a public exchange. During this process, blank check is going to get its own ticker symbol. Let's say it launches under the symbol BKCK. Now that it's public, investors can start purchasing shares. And these shares are available for $10 a piece. Why $10? Well, unlike a more traditional company going public, blank check's shares aren't being priced on the valuation of an existing business, which, as we know, can fluctuate quite a bit. And this holds true for all SPACs. A SPAC's share price at launch is far more predictable than the price of a well-established privately held company, one of the perks of buying in early. So, our SPAC, blank check, has been formed. It's gone public, it's got its own ticker symbol, and public investors are buying in. The question is, what are they buying into? In most cases, your guess is as good as anyone's, because blank check doesn't need to declare a target company until after it's gone public. This is one of the reasons that investing in SPACs is so risky. You don't actually know what you're buying into, at least not at first. So, blank check starts searching for a target company, and this process can take months, even years. SPACs usually have up to 24 months to complete a merger with a target company. If they don't, the SPAC is liquidated and money is returned to shareholders. Now, let's say that blank check finds a company it likes, a nifty little food delivery business called Speedy Bites. Now, it needs to get shareholder approval to go ahead with the merger. If shareholders give the green light, negotiations can proceed and the merger can take place. What happens next? Typically, the special purpose acquisition company takes on the name of the company that it's acquiring. So in this case, blank check will effectively become Speedy Bites, and the ticker symbol will be updated to reflect the new company, maybe something like SPBI. And that's it, really. The investors who bought into blank check before the merger are still shareholders. They're just Speedy Bites shareholders now. And they're free to sell, hold, or buy more shares as they see fit. Now, why would anyone invest in a SPAC? Well, there are a couple of reasons. First, SPAC share prices are low enough for almost anyone to buy into. Most launch at $10 per share. For comparison, when Airbnb went public, it launched at $146 per share on its first day of trading. Second, investing in a SPAC gives investors the chance to get in on the ground floor of a newly public company, and that's exciting. It's also convenient, because anyone who's attempted to invest in an IPO knows how hectic things can get on opening day. But investing in a SPAC lets you become a shareholder before the target company is officially public. Now, investing in a SPAC has its perks, but there are numerous risks to consider. The first is likely an obvious one. You don't know what you're investing in. Because SPACs don't need to declare a target company until after they've gone public, backing a SPAC basically constitutes a blind investment. And that's a big risk for any investor. Something else to consider is how illiquid SPACs can be. The merger process can take up to 24 months. So if you invest in a SPAC right out the gate, it's possible for your money to be tied up for years. The third risk, and this is a big one, there's absolutely no guarantee that a SPAC will perform well. You could wind up investing in a company that you have no interest in, that doesn't diversify your portfolio, and that flops and generates a loss. According to a report from Renaissance Capital, SPAC IPOs from 2016 to 2018 tended to underperform post-merger. SPACs from 2019 to 2020 did a little better, but overall, they still tended to return less than traditional IPO investments. Whether or not you want to add a SPAC to your portfolio is up to you. There are benefits and there are risks. Just be sure to weigh both before you invest. If you're ready to back a SPAC, here is a look at the investment process. First, research sponsors. This step is important. Once you've found a SPAC that you're interested in, start researching the track record of its sponsors. Find out if they have any prior SPAC experience. Look into whether they've made profitable investments in the past. When you invest in a SPAC, you're basically investing in the market savvy of its sponsors. So do your research and carefully vet the company sponsors to make sure that they know what they're doing. 2, open a brokerage account. Like most investments, you'll need a brokerage account to back a SPAC. If you don't already have one, you can compare your brokerage account options on Finder to find the platform that best meets your investment needs. Carefully weigh features, feedback, and fees to find the best home for your portfolio. 3, search for the ticker symbol. Log into your brokerage account and search for the SPAC by company name or by ticker symbol. 4, submit your order. Once you've pinpointed the SPAC, enter the number of shares that you'd like to purchase and indicate whether you'd like to make a market order or a limit order. 5, wait. Once you've invested in the SPAC, you'll need to wait for it to declare a target company to acquire. And this can take a while. 6, stay invested or sell. Once the merger with the target company is complete, you can sell, hold, or buy more shares. It's your call. SPACs are a unique investment opportunity, but they're risky. Without knowing what you're buying into, you could lose some or all of your investment. So carefully vet SPAC sponsors before you buy in. To learn even more about SPACs, check out our guide on Finder, linked below. And if you liked this video, hit the subscribe button so that you'll be the first to know when new Finder videos drop. Thanks for watching.